There's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
You need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's a reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. My first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burnout prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Thea and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G, and it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的 这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
里面有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是你一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers. And it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaqi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded EcoWave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you aren't from this side. I mean, it's corrupt. Your system is...
One of the most dramatic elements was Ravinder Pasi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in this for 16 years.
So Rav Pasi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn, and he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Pasi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Pasi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this is a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera.
It's a very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with J.P. Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, J.P. Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to J.P. Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the J.P. Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid, too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in J.P. Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with J.P. Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as J.P. Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from J.P. Morgan. They issued an award of about $19 million. I reached out for comment, and J.P. Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. And seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory, and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. In amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37, and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to 700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land. And they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3, 4.
If you look at, for instance, Disney, it's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they have done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in the story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
This is a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats all getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial, be like a sports car. Yes. We got up to about 108 miles an hour on that test. And it's a short run, it's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So, for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop. Back
in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
Connection lost.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg TV and radio.
We're back. This is nice. Live from New York City. The countdown to the Fed decision begins right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance. The Fed decides.
Live from New York City for our audience worldwide. Good afternoon, good afternoon. This is Bloomberg Surveillance, a special edition. Thank you, Tom. I practiced that. 28 minutes away from that Fed decision, alongside Tom Keene and Lisa Bramett. I'm Jonathan Ferro. Equities down, Tom, by about 0.4%. That decision just around the corner.
A little tension there. I'm looking at the bond market. I think the equity market is there, and there's earnings, big earnings tomorrow, as we know. John, I'm looking at a yield space that dramatically disagrees with this Fed. I love Katie Greifeld's new Bloomberg Business Week article, Stare Down, and that's exactly what this is today.
The face-off between the market...
Oh, nice.
Rate cut pricing. Yeah. She should have reached out. The face-off between market pricing and the Federal Reserve.
Talking that voice the whole show.
I've got
yes,
no idea.
We're good at it.
Come on, Brammer, that's what this is about.
It
It's
is.
the spread between where the market is priced and where the Federal Reserve is projecting, and ultimately, we need to work out how that spread is going to be reconciled, how it resolves itself in the coming quarters.
In the hours since we've been away, we got some economic data that really didn't make anything clear. I mean, that to me was the takeaway. You got on one side an ongoing contraction in manufacturing. On the other side, you had job openings that came in much higher than expected. So again, this is a very confused market responding to confusing data, responding to a Fed that really isn't taking the upper hand at all.
You mentioned the data. The ISM factory activity, weakest since May 2020. But if you take out the pandemic, we're talking about the weakest numbers going all the way back to 2009. That number has been dreadful, and it's not a one-off. We're talking about the series rolling over now for how many months? 5?
Yeah, exactly. So it's been 5 consecutive months of declines, 3 consecutive reads, I believe, in contraction territory, deepening even more than people had expected. But interestingly, they are still hiring. They're still keeping workers, and this really points to a cyclical structural change that really belies some of the desire for a weakening jobs market.
How much weight does this Fed chair put on the soft data? That's a question later in the news conference. Let's whip through the price action for you. Just a stellar month of gains in January for you to kick off the year 2023. To kick off February, just a little bit lighter, softer negative here, Tom. We're down about 0.4% on the S&P. No comment? Okay. In the bond market, yields lower by 3 or 4 basis points. Bramo, your 10-year, 346.80.
Yeah, well, we are going to look and see if there's any response. I do love that the 2-year is completely flat. Coming up, I'm so excited for this lineup. Perhaps they can make a little more clarity than the data or even the market seem to be giving us. Former Vice Chair Rich Clarida of the Federal Reserve will be joining us, currently of Columbia. TD's Priya Misra also taking us up to that 2 p.m. Eastern Fed rate decision. Then immediate reaction from KPMG's Diane Swank, Bank of America's Michael Gapin, and Vanguard's Greg Davis. And finally, as we get the questions, the answers, all of the pre-written responses from Chair Powell, BlackRock's Jeff Rosenberg, and Deutsche Bank's Matt Lazzetti joining us then. A really incredible lineup, Tom.
Yeah, John, the data check to me that's
you're with us. That's great.
We've seen it. Oh, thank you. The data check that we see here is the Bloomberg Financial Conditions Index, which is Jay Powell's worst nightmare. The summation, it's 11 ratios, and the summation of it is really something. It's a positive standard deviation, and it's the single thing that's gone against the chairman since the last
meeting. I will say this, though. If you go back to the middle of December and look at the closing price of the S&P, we've barely moved. If you look at the closing price of the 2-year yield from December 14th to today, we have barely moved. Likewise, on the 10-year. Depends how you think about these things, Tom, and I'll be fascinated to see how he thinks about this issue in around about an hour from now.
Well, we'll see with the press conference. Of course, Michael McKee in good attendance as well. This is a joy. He's a former vice chairman of the Federal Reserve System, of course, always and forever associated with his Columbia University. He is global economic advisor at PIMCO. Richard Clarida joins us here before the meeting. Professor Clarida, thank you so much for joining us today. I need to ask you about the wish that is out there of an extended level of interest rates being a substitute for moving up quickly to a higher, more peaky interest rate. Is there a theory that says the duration, the length of time of a sustained, say, 5.25% rate can substitute for a higher rate?
Well, thank you, Tom. No, I think right now the committee under the chair's leadership is getting rates into the neighborhood that they need to be according to traditional policy rules, including the policy rules I've worked on. Rates are in restrictive territory. If you look at real rates, I do think you need to do both. You need to move rates into a somewhat restrictive territory, and you need to keep them there. So I don't think of it so much as a trade-off as I think they need to do both, and I think later this year that's where we're going to end up.
I'm taken by the belief out there that the economy will fall apart as we migrate towards a legitimate real rate. What is your reading of the history of monetary policy and what it means for the greater economy? If we do raise rates, what happens to the broad economy?
Well, we went through a remarkable period, really, from 2008 and through the pandemic, when rates were historically low. That was the right call, given that we had disinflation. Right now, it is also the right call for the Powell Fed to be into restrictive territory. You know, Tom, if they get the funds rate to 5.25 by May, which the December dots indicated that they might do, that would be the funds rate that we had back in 2006 under then Chair Bernanke. So it's not ancient history, but it's long enough ago that it may take time for markets to get used to rates at this level for some time.
Rich, fantastic to have you with us on the program again. Yeah. Thanks for being with us. If the Fed chair is asked, and we imagine he will be asked this in about an hour from now, whether we've seen an unwarranted easing of financial conditions, how would you expect him to approach that question?
Well, you know, John, it's a little trickier now than it was in the summer, because in the summer, conditions were easing when the inflation data was terrible. Now we've had 3 good months of inflation data, of wage inflation decelerating, and so I think it would not be right for him to push back entirely on the fact that the policy in place is starting to succeed. You know, you don't want to walk away from progress, but I think he'll emphasize there's still a ways to go. They're going to keep at it till the job is done. And remember, even with these good recent inflation prints, inflation's still running about a point higher at least than they wanted to. So I think that's how he'll try to balance it at the press conference.
They've also got to communicate that in the statement as well. Now, Rich, I know we're getting in the weeds here, but you've been around the table, you've put these things together time and time again. In that statement, there is this phrase, ongoing increases. It's getting a lot of attention from economists on Wall Street. How do you think they'll approach that particular phrase today in the statement?
Well, you've zeroed in, I think, on the money question, John, for the statement itself, because increases is plural, my gut feeling tells me that phrase will stay in, because I think if they take it out, then it really does begin to constrain what they can do in subsequent meetings. They may add an adverb or a qualifier in the sentence. I've been known to recommend such things, but I do think, and we'll know in 20 minutes, I think ongoing increases plural will stay in.
When we talk about the Fed and how much it pushes back against an easing in financial conditions, do you think, like your colleague Abby Joseph Cohen at Columbia, formerly of Goldman Sachs, was saying earlier today, do you believe that equity valuations have already priced out easy money policies and have already priced in the rate regime that we currently are looking at?
Well, I would defer to Abby on equity valuation. What I would say is, relative to where we were a year ago, the markets in the Fed are much closer in the same vicinity of where they both need to be, given the inflation overshoot and the tight policy. I would agree that, you know, from the 30,000-foot level, it definitely looks like the equity markets are romancing the soft or softish landing idea, and I'm in that camp as well, that it's certainly a possibility. So actual pricing I'll leave to others, but I think the better inflation data we've been getting, you know, make that convergence more sensible.
So then, given that we are getting better inflation data, given that some of the data that we're looking at on the softer side is showing a closer measure to soft landing, what do you make of the JOLTS report that we just got?
Well, you know, ultimately the labor market will need to adjust. Now, let me emphasize that through the employment cost index data and the wage data, we have seen a decline in wage inflation, and that's welcome, especially in the context of the openings we're seeing and the low unemployment rate. I do think some further adjustment this year through some combination of reduced vacancy postings and perhaps some pickup in participation and rise in unemployment are going to be required to finally get inflation into the vicinity the Fed wants. But you're right, you know, job openings are part of that calculation.
Hey, Rich, this is wonderful to have you with us. You're going to stay with us, I'm pleased to say. Yeah. Richard Clarida there of PIMCO, formerly the Federal Reserve Vice Chair. TK, that question about pushing back, or perhaps not, against this easing of financial conditions over the last month.
Yeah, absolutely. And the thing that surprises me is the Vice Chairman alludes to the soft landing thesis. I think that's unusual for a sitting or a former former member of the Fed. I thought that was pretty bold by the vice chairman.
Well, the former Fed officials seem to say what they think, Tom.
They say more what they think. Dudley's been very good about that, but
fantastic.
I think Clarida's out on the deep end there with a soft landing call.
Elisa, your thoughts?
I think a lot of the Fed officials are saying soft landing both out loud and behind closed doors because economists are as well. What I find interesting is perhaps Fed officials are looking at market conditions and saying they're just reflecting reality. It's not necessarily that we need to push back, that there's unwarranted easing because of us. And I think that is the distinction.
The incoming information. As for that phrase, cumulative tightening, we'll see, hey? We don't know what kind of damage that's going to do.
We have no clue, especially in line with the Fed balance sheet reduction.
Coming up, Richard Clarida alongside TD's Priya Misra. That conversation just around the corner. The decision from the Federal Reserve about 18 minutes away.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
I don't expect anything surprising from the Fed today. It's all about Powell and Fed's credibility right now.
We are expecting a downshift in the pace of hikes to 25 basis points.
Or downshift to 25 basis points.
The penultimate hike of this quarter.
The rhetoric, I think, stays on the hawkish side.
A reminder that they're not cutting rates anytime soon. The Fed will hold this line.
The market's got a little bit ahead of itself.
The market is trying to call the Fed's bluff.
The markets are wrong.
The Fed has lost a lot of credibility. Let's face the facts.
Chair Powell is going to push back aggressively.
Those animal spirits are not what the Fed wants to be encouraging.
I would expect that he would push back against these financial conditions.
There was a line in there from Bob Michael at JP Morgan. He said the penultimate hike of this quarter. However, he does not think it will be the penultimate hike of this cycle. He thinks there's a real risk here, Lisa, the Fed comes back in later on this year.
That's one of the key tail risks a lot of people are looking at, that if inflation, as you were pointing out earlier, goes down to 4% and just stays there, what happens with the Fed and their sort of a pause in the rate hiking cycle? 15
minutes away from a Federal Reserve decision, just a flavour of the price action this afternoon. Good afternoon to you. Your equity market pulling back just a little bit, down 0.5% on the S&P 500 after some monster gains in a month of January, up 6% on the S&P and more than 10% on the Nasdaq. The bond market shaping up as follows. 2s, 10s and 30s look a little something like this. Your 2-year 4.20.74, your 10-year yield down about 4 basis points at 3.46.62, largely in line with where we were on December 14th at the close time, the last time the Fed met.
John, is anyone modeling a 3.992 year? It seems to be outside the imagination of 100% of our guests.
I mentioned Bob Michael earlier. Do you know what he said, Tom, this morning? Bob thinks that whole yield curve can come down to 3%.
Yeah, exactly. No one is looking for that. I think it's a huge deal and one of the options that's out there. We're going to get back to the Vice Chairman, Richard Clarida, with us from PIMCO. But first, and this is really important, it was the call of last year. Priya Misra joins us with TD Securities. And right now, it's a Priya Misra data screen on the Bloomberg because I've got the vanilla spread, the difference in yield between the 2s and the 10s, at a negative 74 basis points, a 2-year substantially higher in yield than the 10-year. Priya, what does that signal?
It signals that monetary policy is restrictive. It signals concerns around, growth, which is why that long end is staying lower or more anchored than the front end. But I think, the curve is likely to stay inverted all this year because I think today I'm not so sure there'll be such a big market mover. I think Chair Powell is going to reiterate data dependence, hike 25, and leave the door open for more hikes. But I think we go back to the data. I actually think the market is very optimistic that inflation is going to continue to decline. And I think that's why risk assets have done well. That's why financial conditions have eased. That's why the market's pricing in these cuts. If inflation is indeed sticky, I think the Fed, I would take them at their word. They'll continue to hike. So I think that front end can actually rise a little bit more. It can drag the long end a bit higher as well. But I think that inverted curve, I think we're looking at an inverted curve all this year because inflation is just going to be sticky and the Fed is, true to their 2% target. I think that threshold to cut is very high with core services inflation staying high.
What does an inverted curve, highly unusual, do for the greater economy?
So I think it does constrain credit provision. And, it adds to tighter financial conditions. Now, I know financial conditions have eased, and I think that's largely to do with less volatility around people's expectations of inflation. But if you have an inverted curve, I think credit provision starts to slow down at the same time as the consumer savings, accumulated savings are coming down. So the second half of the year starts to look difficult because if the consumers have lost their savings, if the job market starts to weaken a little bit, I think you see the spillover into consumer spending, which is what in our view is going to result in a recession. So I'm not saying the curve results in a recession, but certainly doesn't help when you have an inverted curve.
Given the likelihood of a recession or a potential recession, as a lot of people still believe, despite all this talk of a soft landing, do you think that the 2-year yield is more likely to go to 4.5% or 3.5%? I mean, this is sort of the key question in terms of a Fed response mechanism.
Exactly. So I think it depends on the time frame. In the near term, I would say 4.5. I think, the market's convinced one more hike after this. But if inflation stays solid, and look at the labor market, I mean, that JOLTS report, right from quits rate, job openings, hiring. Now, I know it's a bit lagging, but still, we have payrolls coming out on Friday. We're looking for another strong number. I think if the data holds up, the labor market is holding up, wages stay high, core services ex-shelter, Chair Powell's favorite, what we call core of core measure, stays strong, they're going to have to hike more. So I think in the near term, the 2-year, we would expect that to rise some more. We're looking into next year, we've got the Fed cutting a lot more because by then, if the unemployment rate gets closer to 5, I think they're going to get really nervous and start to cut rates at least to neutral, if not below neutral. And the market's not pricing that in. So, into next year, I would have a lower 2-year forecast, but not this year. I think it's too early to price in these cuts.
We've been talking all morning and all week, really, about how much the Fed is going to push back against the market reaction that we've seen in the month of January and continuing. Do you think that it's necessary for the Federal Reserve to push back on the rally that we've seen in stocks, given that some people believe that equity valuations have now right-sized to the rate picture as it is?
Yeah, I struggle with that because I think the chance of a soft landing is higher today than it was at the end of the year. So if financial conditions have eased because a soft landing looks more likely, look at the global picture. I would say Europe is in a better situation. China reopened. I think they're going to put more fiscal stimulus in. So the global growth picture is a little bit better. Inflation is lower. And so there is a slightly broader path to a soft landing. Now, we're still in the recession camp. But I think it's hard for the Fed to push back against the easing in financial conditions because it's hard for them to decompose how much of that is economic outlook or the reaction function. I think it's going to come down more to the data. The markets ignored the Fed all along that has said that we're not going to cut this year. I think even if Chair Powell says that today, the market will likely ignore the Fed. It's going to come down to data, both inflation and growth data. And that's what I think can bring that disconnect between the market and the Fed can remove that disconnect is if the data shows that no, the labor market is strong and inflation is staying sticky on the way down. I think then those cuts start to get repriced. I'm not sure even if he does push back, which I think may not push back as much, that the market will even pay attention because they've got a different economic outlook for later this year.
Tom, I think this is the way a lot of people think about this. This spread between the Federal Reserve and this market will be resolved in time with actions and following incoming information. Data, it won't be resolved in a statement, not fully anyway, and not with the words of Chairman Powell 30 minutes later.
This is so important, John, and it goes back to all sorts of research from all different schools of economic thought. They're ex post, they wait for the data. As Vice Chairman Clarida said, we've had a bout of disinflation. Then what? And we just have to wait for the data, including what we're going to see Friday.
The former Fed Vice Chair alongside us today, PIMCO's Richard Clarida. Rich, to bring you back in, and again, great to have you with us.
Yeah.
Priya's nailed this curve inversion story through this year. 2s10s at the moment is negative 73. Fed funds is going to be approaching 5, the 2 years at 420. As a policymaker, from your perspective, how would you look at that curve inversion? Is there signal there for you?
Well, obviously, that's been off-studied, and I spent some time on that as vice chair. What I would say is that historically, inversions are a pretty good indicator of technical recessions. You know, PIMCO is in the camp that a recession is more likely than not. I think it does reflect, John, that this is the first rate hike cycle we've had in 40 years where the goal of the cycle is to reduce inflation as opposed to prevent it from going up. And I think that means the inversion can remain longer. And, you know, it's been with us now. You can date it, but it's certainly pretty long in the tooth by inversion standards, and I think it'll stay inverted for a while.
Rich, I got 8 ways to go here and not enough time. I want to speak to you about what a lot of people within the Bloomberg surveillance world think. Everybody's been screaming at recession. I don't think James Perturba up in Boston has let us know there is one. What happened with the recession call? What did we get wrong?
Well, look, here's the way I think about it. Not all 2 recessions are the same, and people forget that you can have a recession, and while it's going on, you don't know you're in it. In both 1990 and 2001, growth was positive for the calendar year, yet later the Bureau called it a technical recession. In those downturns, the unemployment rate rose a bit more than a point. If we have, if I'm doing the show a year from now and GDP growth was positive and the unemployment rate was 4.5%, my friends in Cambridge might call that a recession, but I think that would be a pretty good outcome.
Richard, Olivier Blanchard has out a brilliant monograph, probably my book of the summer. It's just absolutely brilliant, and he emphasizes chapter after chapter how the rules have changed, demographics has changed, technology has changed, all these different overlays. Is this Fed aware of the societal changes in America as they try to grapple with DSGE and the rest of it?
Oh, absolutely. And indeed, I should, truth and Olivier was on my thesis committee, and I'm aware of the book and his work. Yes, obviously, in order to get your view of the longer-term potential of the economy right, you've got to factor in demographics, wealth, income distribution. Those are all elements of the Fed's modeling now. So they're certainly paying attention to that.
Rich, getting a lot of feedback, incoming comments off the back of this conversation. One is from Neil Dutt of Renaissance Macro. He just pinged me a message on the Bloomberg. He said, why are the lags long and variable? Can you ask, Rich? Housing is picking up. Global growth is picking up. The IMF just revised up their growth forecast. Where is the evidence that the unemployment rate is going to go up that much? Claims are plumbing new depths. How would you respond to that, Rich?
Well, I think we've discussed this on your show in the past. Milton Friedman, one of the most important minds of the 20th century economics, very quotable, and one of his many quotes was long and variable lags. I think they may be variable. I'm not that convinced that anymore they're that long. So I think be in Neil's camp on the long part. I think there are some lags in monetary policy, but the financialization of the global economy, I think, means monetary policy is transmitted more promptly than it was 70 years ago when Friedman uttered that quote.
Well, but talking about the globalization, how much did China's sudden reopening sort of disrupt some of the transmission mechanism and make it a much more difficult picture for the Fed to cleanly read?
Great question, and one that we're thinking about. You know, the reopening, typically when China reopens and puts a lot of support, it spills out into the global economy, both through activity and commodity prices. This time it could be somewhat different in the sense that their demand will be less infrastructure and property capital spending and more on the consumer and services, but obviously it's a plus for the global economy when China's expanding and not contracting. But in terms of the inflation dimension, something to be determined.
Priya, it's difficult to approach this question with any confidence or conviction. I wonder if it's too early for Chairman Powell to do anything but just say, we don't know. Clearly it's a plus, in the words of Richard Clowder, it's better for the global economy. Could it be problematic further down the road? We've all got excited about goods disinflation becoming more entrenched over the last couple of months. Do you think that maybe this China reopening story could upset that trend?
It could. It's fair. I would say it is a tail risk. I mean, our thought process, there's so much capacity underutilization in China that, and you look at the unemployment rate, that wages are likely to be more contained, and service inflation is likely to keep overall inflation low. But you're right. Maybe goods inflation starts to pick up. But I think it's also worth highlighting goods inflation or deflation can only last that long. So at some point, we're going to look at CPI, where it's all going to be about services. Then we're going to disentangle that into shelter and ex-shelter and come back to wages. But I hear you. I mean, if goods inflation starts to go up, that's absolutely not priced in. Look at TIPS break-evens. 2% inflation over the next 2 years is what's priced in by the market. I think that's the key to understand what all these markets are pricing in, is a decline in inflation allows the Fed to stop, allows the Fed to cut. And can all be upset if inflation actually stops declining.
Priya, Vice Chairman Clarida has been a consistent, stable voice of monetary policy in the nation. We all know that. But there's a massive history here of central banks getting it wrong. Are they acting asymmetric out of fear of making mistakes, as have been done by the Bank of Japan as an example in the past? Is there a risk of going one way or the other too much?
I think, they've been saying, and I hope Chair Powell's asked about this, are the risks still asymmetric towards inflation? I think the way they've been acting, they're far more concerned about doing too little. When does that shift? I mean, there's some Fed officials that are arguing that it's shifting now. Is that the committee view? Is it becoming more balanced? And I think the market's pricing that in. I would still say the inflation risks are still too high. Given the labor market, I think the risk of doing too little is still high, but that's the eternal trying to find that balance, right, between growth and inflation for the Fed. And I think, I hope he's asked about that.
This was wonderful. I'm sure Mike McKee will do his best a little bit later. Priya Misra there of TD, and to Richard Clowder of PIMCO, and of course the former Fed Vice Chair. Rich, thank you. It's good to catch up as always. We are about a minute away from the Federal Reserve decision, looking for 25 basis points. It seems like the market's been leaning towards that outcome, and it's been widely endorsed by Fed officials, Tom, over the last couple of weeks in the Fed speak leading up to this.
Dissent? I don't get this is a time where I'm like, nah, this is not the place to step.
I'm more interested as the meetings go by, Thomas, whether we start to see that.
Yeah,
I think it's about that time.
And let me make clear, the British do this much better than we do. I mean,
well, they actually dissent.
I mean, I think the heritage of this from Greenspan is not constructive.
Do you think the dissent is more likely that people wanted 50 basis points, or that people wanted to remove language that was more aggressive?
No, I clearly think there is a range for the terminal rate. And you see that implied by the projections in the summary of economic projections. As we get closer to that terminal rate, you're going to see some dissent. Some people want to go further. Other people are going to want to pause.
We're getting closer to that, though this time around, it is going to be in the nuance that's going to be most important.
The Fed decision, just moments away. Let's get some price action for you going into that Fed decision. Equities look a little something like this on the S&P 500. We are negative 0.4% on the NASDAQ. We're down a little more than 0.1%. That Fed decision should cross the wires any moment now. There you go, 450 from 425, 475 on the upper bound, 450. So that is a 25 basis point hike from the Federal Reserve. I'm going to bring up the statement just quickly and work through this one, and then Mike McKee is going to join us. Here is the statement from the Federal Reserve. Recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation has eased somewhat, but remains elevated. They go on to say Russia's war against Ukraine is causing tremendous human and economic hardship and is contributing to elevated global uncertainty. The committee is highly attentive to inflation risks. They go on to say this, and this is probably the key paragraph, so work with me, and I'll go through this verbatim. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer term. In support of these goals, the committee decided to raise the target range for the Fed funds rate to 4.5% to 4.75%. The committee anticipates that ongoing increases in the target range will be appropriate. So that line sticks. It goes on to say, in order to attain a stance of monetary policy that's sufficiently restrictive to return inflation to 2% over time, in determining the extent of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects activity and inflation, and economic and financial developments. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, Lisa. As described in its previously announced plans, the committee is strongly committed to returning inflation to its 2% objective.
I would say that this is a Fed holding close to its vest, but I think you pinpointed the key phrase. They repeated that further rate hikes would be appropriate, and that seems to be what markets are responding to.
Let's pick up on the price action just briefly. Your equity market is lower by 0.5% on the S&P. On the Nasdaq 100, we are down by 1/3 of 1%. Looking into the bond market briefly, we are higher at the front end by about 3 basis points. So that ongoing increases phrase sticks in a statement. We'll catch up with Mike McKee in just a moment on that. Your 2-year at the moment is 4.23. Your 10-year lower by 3 basis points at 3.48. The curve a little bit more inversion here. 2s 10s down to -74. We're down about 5 or 6 basis points. So TK, it's over to you, Chairman Powell, in about 28 minutes.
This is exactly the chart I want to look at. For those of you on Bloomberg Radio, it's just simple. 2s 10 spread makes a leap here. And John, to get out beyond 80 basis points, a difference in yield of 0.80% would be an extraordinary statement by the fixed income market on this Fed.
Do we get some heavy lifting, Lisa, from Chairman Powell in that news conference to push back a little bit more against this idea that we get cuts sometime soon?
That will be a fascinating development. Even more fascinating, will those price moves stick? Will the market believe the sort of hawkish tone to this idea that there are ongoing rate hikes that are still appropriate in the face of diminishing inflation?
I always find these meetings very strange because you don't get the projections. We've got to wait a couple more months.
Totally agree.
Wait for the March meeting for the projections. So this one's a simple one. There's the statement, a 25 basis point hike in the rearview mirror. In front of us, 27 minutes away, is a news conference with Chairman Powell. Joining us now, I'm pleased to say, is Diane Swunk, the chief economist at KPMG, and Mike Apen, the head of US economics at Bank of America. Diane, first to you. Your response to those words from this committee this morning, or rather this afternoon?
Not at all surprised. This is a Fed that really has been pushing back, particularly on the easing of financial market conditions. They don't want financial markets credit easing to undo the progress we've seen on inflation. And given today's job openings data with 11 million at the end of December, 1.9 job openings per job seeker during the month, that is in the wrong direction for the Fed, along with announcements by the largest employer in the country this month that we'd see an increase in entry-level wages from $12 to $14 per hour. And that is something that the Fed does not want to see. They're not only worried about setting too high of a floor under inflation as it comes down, they're going to be worried about a reacceleration in inflation in the months to come and a reacceleration in wages. They want wages to accelerate without inflation. The hard needle to thread here is to slow inflation more rapidly than they cool wage growth.
Michael Gapin, what's your reaction to this statement? Pretty much very in line with exactly the expectation that people had. What's your main question for Fed Chair Jay Powell in about 25 minutes' time?
Well, I would say I have two questions. You know, is essentially the extent of further rate hikes. So they modified that language. We had expected that, right? Are you still thinking something a little bit above 5% is appropriate? And then maybe a follow-on to that, I'd echo what Diane said. The labor market is quite solid. The data today doesn't suggest it's slowing down all that rapidly. The other thing I would say, so how else could the Fed push back against expectations of easing, for example, that are not related to the policy rate? Governor Waller brought up this week, or last week, I think it was, before the blackout, that maybe we can run our balance sheet off even as we're reducing rates. So is there guidance here that's more than just about policy rates, Could it be something around the balance sheet? So if they were concerned about financial conditions easing too much, might that come to the forefront and be on the table?
Meanwhile, there is a question, Diane, about whether the market is actually acting appropriately and whether it's really the Fed's job to job out and distinguish what's Fed policy and what's just fundamentals that might be perhaps turning around. What are you looking for in terms of their guidance of whether to go further, how much further to go, and where the balance of risks is in going too far or not enough?
Well, I think they're more than willing to actually look at the economy and saying where we are today, they're more willing to risk overshooting than undershooting. And the reason for that is that balance sheets have healed dramatically from where they were, not only household balance sheets, but corporate balance sheets. And that's why they're so worried about financial conditions offsetting and moving in the opposite direction of where they're going, because it actually could not only undo the progress they've made on inflation, but actually trigger more inflation. And that's something they're very concerned about, is that we're now in an economy, a mirror image or reverse image through Alice's proverbial looking glass from where we were. Instead of them trying to raise rates and finding the economy responded too much every time they raised rates, they were able to raise rates a lot last year. And it now looks like the economy is more susceptible to rate cuts and easier to stimulate. And so that also feeds into a bias to overshoot in rate hikes rather than undershoot. They don't want to repeat the mistakes of the past. They're haunted by 2021. Governor Waller also made reference to that they had a 3-month improvement in inflation in 2021 and then were head faked. They don't want that to happen again. But they're haunted as well by the 1960s and 1970s and the stop and go policies of then. They see this as a marathon, not a sprint. They're not going to stop till they cross the finish line. And that means getting inflation back to 2% or just nothing that will distort any behaviors out there. We are not there right now.
Diane, that was beautifully explained. I mean, this really, folks, goes to the asymmetric regret looking back that any central bank has. What's fascinating to me, Diane, is the idea that they're going to overshoot in some way, waiting and waiting for 2%. Do you see a Fed that out in 24 or 25 is going to begin to amend a band around 2% and migrate that to a higher level?
They could down the road. They won't do it until this war on inflation is won. I will never forget Neil Kashkari and his comments at Jackson Hole saying, we're not going to go to 3% and set that as a target in the middle of a raging inferno. What he meant by that is the Fed cannot move the finish line when they're battling inflation. They've got to cross that finish line. And when they come back and reassess what is the appropriate inflation rate after the last time they assessed what the appropriate decision rules were, they could come back and raise it, but I don't think it's going to be as soon as many people think because of how long they think it's actually going to take to get inflation down to 2%.
Michael, your shop has such a handle on America. I mean, there's just no other way to put it. It's the heritage of the bank. How close are we to economic slowdown? If there's parts of America, 2, 3, 4 Americas, what portion of America is actually feeling recession now?
A third, maybe. I mean, we see it certainly in housing and some of the non-residential business spending data. We're seeing it in the manufacturing data, but in the consumer growth in consumer spending has slowed. But you don't get recessions in the U.S. if the consumer continues to spend at roughly a 2% rate, and that's what they did over the past year. So to take some of these pressures out of the labor market, you probably need to slow that more. The January data on spending, our proprietary card data that we look at shows actually a pretty decent bounce in spending in January, reversing some of what we thought was a seasonal weakness in December. You've got increases, cost of living increases for Social Security, the readjustment of tax brackets, the increase in federal employment salaries that kick in. So we're likely to have kind of a one-time increase in income and spending here in January that leaves us with pretty good momentum.
Mike, there is this line in the statement. Let's work through it together. It says the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation. We had this conversation with Rich Clarida about 15 minutes ago. What lags, Mike? Just how long are those long and variable lags?
Well, the standard rules, I think, as Rich was alluding to, but he didn't say quite this way. 12 to 18 months is about how long it takes the cumulative effect of policy to bake in. So yeah, some of it gets baked in faster. The interest rate sensitive sectors are slowing. I kind of think the remainder of it is still in front of us. We do think the consumer will face more headwinds as the year progresses. So something in the second or third quarter might be when most of the weight of prior tightening shows up in consumer spending. So I don't think we're there yet.
You'll excuse me for being somewhat impatient, Diane, but if you'd asked me back in August whether claims would be at 186,000 at this meeting, I would have said no, probably not, and they'd be going in the other direction. So is there anything to learn from that?
It's really been amazing how stunningly strong the labor market is, and that's why the Fed has it in their target. And I think that's what's so hard about where the Fed is standing right now, but they certainly are not willing to back down. The fact that the labor market is where demand and supply is now the most out of line is important. We're talking about 1.9 job openings per job seeker in the month of December. That's close to the record highs that we saw in 2022 when wages were accelerating. Also important is that 8.7% increase in Social Security that Mike mentioned. That's really important because that's $8.9 billion in cash that 66 million, at least, consumers got in January alone. That is a very important amount of cash that is all likely to be spent. And from the spending data that he just mentioned, they are spending it. That is likely to be on services and necessities and put, again, an additional reacceleration in inflation in play. And that's what the Fed is worried about.
We're looking at markets that initially sold off, that stocks sold off. Bonds did as well in response to the statement. The NASDAQ has reversed, interestingly, as people parse through this, which, John, I actually find pretty interesting. It's sort of the market wants to go up regardless. It was, multiple hikes, whatever. Okay, let's go up. Things are good.
There's a lesson every time the Fed meets. It's never been too much of a story just before the news conference starts. It's kind of like the earnings reports, right? The earnings come out, you wait for the call and the guidance. And I think on Fed Day, Tom, it's kind of the story with the Fed too. You get the statement, okay, hands off. Let's see what the chairman's got to say in 18 minutes.
You nailed it. We're addicted to the guidance. And in the defense of everyone, why aren't they giving us guidance every meeting? I mean, it can be lesser guidance. I get that. But there's sort of a vacuum here to move on. I'm sorry, I don't have these memorized, John. I'm trying to. I took a quiz and flunked. March 22nd, May 3rd. When does this get important again? I don't have an answer.
So if we had the
June
statement
14?
today, Tom, alongside a summary of economic projections, Dan, I think this is a question for you. Dan, if we had that SEP today, how do you think it would evolve relative to what we got in December?
Good question.
I actually don't think it would change as much as people think. We have those doves rotating in. We had a lot of people talking about maybe a pause in rates. Patrick Harker, who's a voting member of the Fed now, Lori Logan from the Dallas Fed, who's a voting member, Austin Goolsbee is now a voting member of the FOMC at this meeting as well from the Chicago Fed. All new voting members, Neil Kashkari now on the other side, who used to be a dove, now very hawkish. I think it's really important to understand that the data we've just gotten in the last couple of days actually hardens the Fed's resolve. And Chairman Powell went out of his way to say that there was no one who had a rate cut priced in December in the SEP when he talked about it. Now, Chairman Powell doesn't really love the SEP. It's something that's been sort of a thorn in his side at times. But I think that was very important guidance that he gave, that no one had a rate cut for 2023. The Fed really wants to hammer that point in. And even though we have some doves on the Fed, they're going to be relooking at the data that's just come in and say, you know what? We should stick to where we are. Stay the course is what we heard over and over again. This is going to be a very hawkish description of that meeting. And I don't think there's as much debate as many people thought was emerging. I think that just got quelched by the data we've seen.
And Mike Apen, your thoughts?
So I would agree. I don't think the SEP would have changed all that much. I think the terminal rate projection median would be about the same. I'll just make a point, though, in this regard. You can be hawkish in what you do. You can be hawkish in what you say. After slowing down for the second straight meeting to 25 basis points, it's going to be really hard to change the effect of that, right? So if they really, really wanted to push back against expectations of easing in financial conditions or cuts later, or just if they wanted to kind of, reassert their intent, they could have gone 50 and they didn't. So there's not a lot, I think, that you can talk about at this point without another forecast, to really kind of change what markets think. Markets know you slowed down again. So, it's a dovish meeting on net relative to where the committee was just a month or two ago.
If it's a dovish meeting, Michael, and it was nice of you to arrange for CPI Wednesday or whatever it is to be Valentine's Day. Did you know that, John?
I didn't know that.
CPI is Valentine's Day. Michael Gapin, what if we get a disinflationary tinged February 14th CPI day? What does that do to our world?
Well, it reinforces the view that we're past peak inflation. It probably means it's easier for the Fed to accept that inflation's moving lower. And it would reinforce the view of the minds of markets that the Fed could be cutting later this year. So the faster inflation dissipates, then the Fed's at risk of its policy rate getting too tight, right? So there's some probability that you'll get cuts later this year. So I think it would reinforce the narrative.
Dan, you have an understanding of the Midwest of this nation like really no one we speak to. And I want to go to the great Jim Glassman at J.P. Morgan, who is heated in his commercial banking meetings of the optimism of America. I looked at a zip code in Kansas a couple days ago on a Blackstone thing, and the unemployment rate is 2.2% in Kansas. Is the East Coast, are the elites like Lisa Abramowitz overwrought about all this while America booms?
Certainly we are.
Sorry, go ahead, Diane.
I was just going to say on the Midwest, it's really interesting to see the job opening data today in some of the states that are seeing declines in openings like Texas. Related to the tech sector, their job openings actually declined. Florida's still strong, but actually much of the job openings that we saw accelerate were in the Midwest, including Illinois, Wisconsin, Iowa. That's important. That's been a shift that we've seen. And talking to the automakers and OEMs, what we're hearing out there is that although they'd like to ramp up, they're worried about affordability on vehicles. And even though they'd like to ramp up as China reopens and they get more chips, they also just don't have the workers to do it, and they're going into UAW contracts in June, and aren't running third shifts right now, and that's important because labor is a constraint to them. That is something we have to watch very carefully.
Diane, just quickly, we usually give you the opportunity to pose a question for Chairman Powell. Can we wrap things up by doing that? Your thoughts going into this one?
I think they need to ask them yet again, what role do financial markets play in their decision making? How do they want to push back against financial markets? And I actually disagree. I think they can go ahead and go 50 if they actually felt like the situation was deteriorating and inflation was accelerating again. This is a Fed that's shown its willingness to do a U-turn and do it aggressively. I would not underestimate their commitment to doing that again if they felt it need be.
Mike Gapin, final word. Same question to you, sir.
Well, so I'll refer back to what I said earlier. Is it on the table that balance sheet runoff can continue even if you're cutting rates? So can you mix your instruments in a different way to keep financial conditions tighter for longer?
Mike Gapin, Diane Swanton, to both of you, thank you. If you are just tuning in, we are 12 minutes away from a news conference with Chairman Powell after the Federal Reserve chose to hike interest rates 25 basis points, another downshift. We're looking for some form of, wait for this, Tom, you'll love this phrase, hawkish downshift.
Oh, you're killing me.
When you go from 50 to 25 and push back against market pricing for rate cuts.
Every guest that we have is different. And Diane Swank from Bank One a few years back, working for Mr. Diamond when nobody knew who he was. And the bottom line is, John, there's a labor fabric here. And that is, El Arian talks about the unknown unknown.
Sure.
The unknown unknown right now is the American labor economy. And it looks like to me, away from the tech, overhiring and that, it's a job-making machine. She just said that there. And the underlying is Amazon and $17 an hour. That's changed the entire dialogue of labor in this country.
Totally agree. If you're looking to the statement this afternoon from the Federal Reserve, that line is still in there. The committee anticipates that ongoing increases in the target range will be appropriate. The market response, Lisa picked up on this, down, back up, down again. We're down 0.4% on the S&P, the Nasdaq largely unchanged. At the front end of the yield curve, the two-year yield just a little bit higher by 3 basis points on a 2-year to 4.22. You can call it 4.23 On a 10-year, we move lower to 348, so the curve a little bit more inverted, negative 74 basis points, the 2s-10s curve right now. I'm pleased to say that joining us is Greg Davis, the Vanguard CIO, waiting patiently. Greg, fantastic to catch up with you, sir. It's been too long. We are about 10 minutes away from this news conference. Greg, can I just get your first thoughts on that statement from this Fed about 20 minutes ago?
That statement was in line with what we were thinking in terms of, going 25 basis points this meeting, and then the need to do ongoing increases is pretty much what our economics team is forecasting for the Fed to go to a 5.25 type rate over time.
Greg, you've got a wonderful John Bogle view on your Vanguard note that if you miss the 30 best days going back a few years to 1928, you're wiped out. You don't get to play. How do our viewers and listeners get to play given the cacophony and noise of a Fed?
It's a great question, Tom. The reality is what we say to our investors is that they need to stay fully invested at all times. And the point of that note was really the fact that if you miss the 30 best days, you're ultimately going to reduce 50% of your long-term returns. And we know it's unbelievably hard for investors to time markets. So for those investors, we just tell them to focus on the things that they can control, balance, diversification, making sure they're investing in funds that offer low fees to make sure they retain the majority of their earnings in the marketplace.
The heart of the problem here, and it's something Vanguard and others are known for, is you got to be in the market. And the basic feeling here is things are going to fall apart in a 78, 79 pre-Volcker way. We've ebbed away from that with a spectacular January. What does this Fed need to do to relink with a market that's moving away from their theories and policy?
Well, I think there's a couple of things. One, it boils down to fundamentals, and we know that the Federal Reserve is trying to get inflation under control, and they're doing a great job at that. When we think about how we're looking at the economy going forward for the remainder of this year, we're seeing inflation come down to 3%, around that range at the end of this year. But that last mile from 3% to 2% is going to be a bit challenging, just given that's going to be driven more by what's happening in services. And so that's where we think there's going to be some challenges. And then when you think about the markets more broadly, when you look at valuations, bonds are back. We're back to a place now where bonds are actually offering attractive yields. We're at a place now where even in money market funds, you're actually being paid to save money, where in the last decade, you were not being paid to do that. And so what we've been trying to counsel our clients on is the fact that don't leave money sitting in a bank account where it's earning 30 basis points at max, where you can sit there and invest in a money market fund where you're earning 4.3% or so.
Yeah.
That's real money.
We were talking about the market response to this somewhat, some would say hawkish, some would say in actuality dovish statement. There was a comment out on Twitter by an FX trader basically saying, right now, words mean very little from the Federal Reserve. Bonds know this, that the market basically is looking past anything the Fed will say. Is there anything that Fed Chair Jay Powell could say in, say, 8 minutes' time that will catch your attention, that will make you shift your view?
I think a big part of it is really how he's thinking about the market more broadly. And when we look at financial conditions and the fact that they've eased up so much over the course of the last 6 months or so, if he were to come in and say something more aggressively than what the market's expecting. So again, our view is that there's going to be a couple more rate hikes, which is in line with the language. But if he were to say, the market is way off base, I don't think that's going to necessarily be perceived well by the equity markets, which in our view still seem a bit stretched from our perspective.
So that's actually what I was going to ask next. Do you think that markets, the equity markets, have fully priced in a rate regime in the 4% handle, even 3.5%? Or are they still kind of working through the hangover of zero rates?
It feels to us that there's a lot of good news that's still being priced into the equity markets. I mean, when we look at our Vanguard Capital Markets model, our projected returns over the next decade for U.S. equities is somewhere in the range of about 5.5%. When you look at U.S. bonds, our expected returns there over the next decade is about 4.5%. And there's a clear difference when it comes to volatility between those two sectors, with bonds having about a third of the volatility that you'd find in the equity market. So, on a risk-adjusted basis, bonds look really attractive for investors. But what we'd say is that making sure that you have balance and diversification in your portfolio is going to be critically important. And bonds are going to serve a much greater role providing diversification benefits than they have over the last number of years, just given that rates were suppressed.
Greg, let's nail you down on this. In a treasury market, we've heard it a few times, that it's the year of fixed income, the year of bonds. Is there any way that could go wrong in a treasury market? What would that look like?
The thing that could go wrong there, Jonathan, and I appreciate the question, is really whether or not inflation ends up being unhinged and ends up not coming down the way we forecast. Now, if we got into a place where inflation was really, elevated at 4 or 5%, and it wouldn't come down to that 3 or 2% over time, that would be problematic to the bond market.
Greg Davis there at Vanguard. Greg, this was wonderful to catch up with you, sir. Again, it has been too long. Thank you very much. Your equity market then, down about 0.4% on the S&P 500. Your bond market selling off a little bit at the front end. So yields higher on a 2-year by 3 basis points to 423. On a 10-year down 2 basis points to 348. 2-year yield higher, 10-year yield lower. That means the difference between the two gets wider. The curve a little bit more inverted, negative 74. The difference between the two, that widens by about 5 basis points, actually. So that's the price action in the bond market. If you are just tuning in, about 25 minutes ago, the Federal Reserve hiking interest rates 25 basis points. There was a big fascination, obsession almost, with the statement and whether this phrase ongoing increases would remain in the statement. Tom, it did. The committee anticipates that ongoing increases in the target range will be appropriate, but how much further are they going to go? And that's the mystery for the rest of this year as the gap between the Federal Reserve and this market persists.
Maybe it's the mystery of the press conference. I love what Chris Lowe writes up at FHN is this is, it's an important statement and all that, and the story's driven forward. But this press conference becomes where every nuance of it really matters because I didn't get much out of the statement. So to me,
no real change.
The press conference coming up, possibly with McKee's rude questions, plural, as always, will be, it could be market moving.
Lisa and I have discussed this through today. In fact, we all have over the last couple of weeks. We know in this news conference, which starts in about 4 minutes, the chairman is going to be asked about the easing of financial conditions. We had a conversation with Rich Clarida, the former Fed vice chair, about 30 minutes ago and asked him how the chairman would tackle that question. I have to say he was pretty nuanced about it. Lisa, he didn't say you'd get this full emphatic pushback by the Fed chair. Now, let's assume you do get one, though. Let's say he pushes back. The mystery to me is how the market responds to it.
Especially because they didn't raise rates by 50 basis points as they could have. And this, to me, was the key comment from Michael Gapin at Bank of America. This is a hawkish statement, but the action is dovish. They could have gone 50, they didn't. And that's what markets are responding to. If they do a full-throated pushback of the markets, why didn't they then go 50?
We're watching what they do, Tom, not what they say. And clearly, they've been stepping down over the last couple of meetings.
Yeah, absolutely. But watch what they do is they're going to look at the data. And it's the first time we've really talked about it. I'm sorry, one inflation report, another inflation report, a third inflation report, and that gets you out to February 14th. And I'm sorry, it could be a complete change off of jobs that we don't, do I look at ADP today as a legitimate number? No, I can't. I could be wrong.
Are JOLTS legitimate? People are asking
I think
that
JOLTS,
too.
I think JOLTS are more proven than ADP.
There is clearly a tug of war right now between the soft data, the survey data, and what we're seeing in the labour market with claims. And I think today, the data so far we've had today really captures that from early this morning. The fact you've got an ISM, factory activity reading, the weakest since May 2020, and if you take out the pandemic as the weakest since 2009, that sounds absolutely dreadful. You'd be asking yourself, just on that basis, on that data point alone, why on earth is the Federal Reserve hiking interest rates? Never mind 25 basis points. And then you go to job openings, to jobs, Bramo, to your point. Openings climbing to what, 5-month high? Yeah. And now we've got the ratio of unemployed to openings, which we know the chairman looks at, pushing 2 again at 1.9.
1.9, which is just shocking. Tom said earlier, we're minting jobs, we're making jobs a lot. That's not really how I would phrase it. We don't have workers. Perhaps we're losing workers faster, and this is a new structural reality that is really causing some distortions and difficulty understanding the
Thank you for bringing this up because this is so important. We mentioned it with Professor Clarida, but Olivier Blanchard is there's huge overarching factors here, which Diane Swank talked about, is they just flat out can't find the workers. I think that defines fully employed America.
Should we give Mohammed the final word? Who didn't join us today, but we can give him the final word anyway.
I was here, so he said no. That's all there is to it.
Alarian had this to say out on Twitter. The Federal Reserve doesn't seem to be able to overcome the financial conditions paradox, with such conditions already looser than when the Fed started its hiking cycle. Markets took virtually no time to shake off the initial negative price action due to the more hawkish language. Lisa, it's words versus action.
And that really is the verdict right now. Action trumps words. And the market's going to look for the action, and that's the entirety of it. And yes, they're going to watch the data, but ultimately, Fed Chair Jay Powell can say whatever he wants. I don't know what can get the market's attention right now.
I got 6 seconds because Powell's always on time. Guess what? I'm going to go to the American philosopher Neil Dutta. It's a pretty good economy.
You saw what Neil said this morning in that message to me. Housing's picking up again. Global growth is picking up. The IMF. I've never seen an economist on Wall Street bring up an IMF forecast in the way that Neil has, but we'll let that one go. The IMF just revised up their growth forecast. Where is the evidence that the unemployment rate is going to go up that much? Claims are plumbing new debts. We get claims tomorrow?
Yeah.
Tomorrow morning?
Tomorrow morning.
186,000 last week.
We aren't seeing it in the claims. We aren't seeing it in the jobs creation because it's supposed to be south of 100,000 for a couple consecutive months in order to get to the unemployment rate that people are looking for.
Chairman Powell walking in after hiking interest rates 25 basis points. Here's the chairman of the Federal Reserve.
And welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris Rugaber, the Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder, and could you see lifting rates higher than you otherwise would to offset the increase or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up. for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil. Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. We've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Colby and then Howard. Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage, whereas of course we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see. Our goal, of course, is to bring inflation down. And how do we get that done? There are many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's, around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is. Research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above-target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
Well, you'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria. Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization in effect, is what you're, okay.
Yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina, and then Steve.
Gina Smilek from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may be responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector. That's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But that's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator, of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year. And that's my base case is that there will be positive growth this year.
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months. We've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence?
So I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job. And it's a fine job. It's a great job. I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down. And Congress did what it did, and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. If that happens, if inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon. Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession. And we have inflation moving down, into somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if we get our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time. But we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in in the Fed's monthly post-meeting statement as an ongoing economic risk as opposed to, a health issue.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I wanted to go back to another thing that Fed Vice Chair Lael Brainerd said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
People are talking about inflation all day long, every day. The more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are, we pick that up in conversations, and I've seen some data too that show people are, gradually, they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. Is consumers and businesses. Essentially, we believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. In this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast, but our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or
I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk, the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up. And we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
That wraps up the news conference with Chairman Powell, a balanced Fed Chair, Jay Powell. I can tell you the market screaming one thing, and that's we've got our own view on this. Equities look like this on the S&P 500. Good afternoon to you. This is the Fed Decides. Equities off to the races at 1% on the S&P. On the Nasdaq, up another 2%. Year to date, the Nasdaq 100 is up almost 13 percentage points. In the bond market, big moves, yields lower. On a 2-year by 8 basis points, 4.12%. On a 2-year, on a 10-year, down 10 basis points to 340. TK, the Fed chair, says we need to stay restrictive for some time. The job is not fully done. There's a lot of work to do. It's premature to think we've got this. He said if the economy evolves in the way they anticipate, they don't see a 23 rate cut, and yet this market is leaning hard the other way.
We sort of guessed this. It was a snooze statement, up we go, no big deal. And we said maybe the presser will be there, and the presser for a number of minutes was as expected, and then maybe like I've never seen. It's not that we're up, John, it's the way we're up. Out there right now is a massive short cover into some form of dovish outlook.
I just got a message on the Bloomberg. I won't reveal who it is until they give me permission to do so, but I can share the words with you. This is what happens when you don't validate the December dots. That's the view out there on Wall Street at the moment. Yeah. I would go one step further. In a sense, Lisa, he was recognizing that the market was appropriately adjusting to incoming information. And then at times, in fact, I would say repeatedly, unconvincingly and unsuccessfully, trying to lean against easy financial conditions simultaneously. Then at the end there, and we talked about this before the decision, he basically said financial conditions hadn't eased too much compared to where they were at the last meeting.
Which is a shocking statement, and I want to just point that out. Mohamed El-Erian putting out and saying, not sure which index he is using. The most widely cited ones show overall financial conditions as loose as they were a year ago. Indeed, the Bloomberg Financial Conditions Index shows the loosest financial conditions going back to February of 2022. So, okay, that's number one. But number two, I would say right out of the gate, the market's got the memo. The first question, just as we said, Jay Powell, are you concerned about how the market has rallied, about how loose financial conditions have become? Immediately, he could have said, yes, this is a huge concern. Instead, it was, I'm not sure.
There's a lot of that, wasn't there?
And then all of a sudden, markets
She did that nicely.
Yeah. That was basically, that's the short version of the news conference. He was asked about whether they discussed the pause. Now, if you want, can you do that sound effect again? Because that would be appropriate. It was kind of,
read the minutes.
Wait for the minutes. Wait for the minutes, TK. TK, what did you make of that? He's asked directly about whether they discussed a pause at this meeting in the last couple of days, and you got nothing back.
You got nothing back. And the whole tenor of it was one of disinflation. I'll let somebody count how many times he said disinflation. John, I actually was thinking, and folks, I can't convey enough the velocities of the market here speaking. Price up, yield down. John, the 2-year yield to 4 digits at one brief second, 4.0981. I was thinking to myself, is this guy going to drive the 2-year under 4% by the end of the conference? If McKee had asked 3 follow-ups, we may have gotten there.
Hey, earlier on this week, we asked, what are you more interested in, the words of Chairman Powell or the economic data? Based on that performance, I'd rather hear from the economic data. Wouldn't you, Lisa?
I mean, basically, what it screams is that he is looking at the disinflation and cautiously optimistic. The idea that he's still talking about a soft landing really highlights just this, saying that, yeah, maybe the balance of risks, hem ha. You've got concerns about perhaps not going far enough, but things look pretty good. Again, this isn't the pushback that people are going to look for in the market.
I like that question on the balance of risk. It came from Colby over at the Financial Times, I think.
Yeah.
Colby Smith. Do you remember Colby?
Yeah, I remember, yeah.
Used to be the class of surveillance many years ago.
Really?
She asked about the balance of risk, and he kind of danced around it. Maybe 4 months ago, he would have said the risk of doing too little outweighs the risk of doing too much. And then he sort of ummed and ahed. Very difficult to manage the risk of doing too little, and obviously if we do too much, we can do something. But it lacked any real conviction, didn't it?
Okay, so here's the real question. Does he mean what he says? Because if he does mean what he says, why didn't he go 50 and then just pause, right? I mean, in other words, if he really is concerned about financial conditions at any level, all, then why didn't he do that? And really, that is the screaming conclusion after this press conference.
I'm looking at 2.05% NASDAQ lift. You know, the Dow not playing. SPX, I think, is playing out the new highs, 41.18. And I'm thinking of corporations going, okay, we need to buy back shares. And the CEO's on the phone right now screaming, why didn't we do this last Wednesday? Again, folks, you don't see this. It's the red and green of the Bloomberg